Okay, so good afternoon, good morning, good evening, depending on where you are in the world. I am Ross Burland, pretty excited Ross Burland today ahead of the major event that is the FOMC decision that's coming up in 15 minutes time. I'm joined today by our very own Valeria, Chief Analyst at FXStreet. How are you doing?
Hi, Ross. Hi, guys. How are you? Fine in here. Also waiting for the Fed.
Absolutely. Okay, and Yohay Elam from ForexCrunch. How are you, sir?
I'm doing great. Looking forward to some volatility.
Okay. So the idea of today, obviously, is to give our audience some insights as to the price action that we might see around the number and throughout the statement when that starts getting digested by the market, and the press conference that will be 30 minutes from the release of the interest rate decision. I would like to quickly look at the market now. So we've been in consolidation. Obviously, that's generally what happens before a major release like this. Markets don't want to be too positioned either way. Euro dollar, we are in a tight range there. We've had a high today so far of 106.70 and a low of 106.11, and we're around about in the middle of that range at the moment, sitting steady. Cable, we've had a bit of movement in that today. We had some decent data out of the UK earlier, but leading into the event, we've stabilized just below there, the 127 handle. And the yen is looking a little bit soft up here at 115.33 at the moment. We've come down all the way from 114.76, and the Aussie there has been struggling day in, day out on the 75 handle, and we're tucked just in below there at the moment, waiting for this release. And gold has been struggling in this era of Trump. The market has been, obviously dumping bonds, and yields have been rising, and a lot of money has been flowing into demand-driven markets, and that's obviously adversely affected the gold. But just very quickly then, guys, sort of 13 minutes now leading into the release. Valeria, have you got any insights, any ideas? Is going to be the decision, and how do you think the markets are going to react on the release? Are you with us, Valeria? Okay, I think we've lost Valeria. Yohay, are you there?
Yeah, I'm here. The Fed is expected to raise interest rates for the second time after the global financial crisis. After a year, we had expected 4 rate hikes in 2016. And we're going to get only one, and it's going to be today. It's not going to be a big surprise. The big question is the tone of the Fed, the dot plot. Are they going to be more optimistic, and that'll be dollar positive, or more pessimistic? My base case scenario is that they're unlikely to change any predictions. Try not to rock the boat. Try not to predict the unpredictable Trump. Repeat that they're data dependent, and they'll go with the flow in easier words. So I don't expect in this case, if they don't do anything, I expect the dollar to drop a little bit against the euro and the yen, which have lost quite a bit of ground. And in case they do surprise us, they're positive, have a glass half full view. I expect the US dollar to rise, especially against the pound and the Canadian dollar. And if they're more pessimistic, downbeat, then of course the dollar will fall and the yen might reassert itself as a safe haven currency.
Okay, excellent, thank you. And Valeria, are you back with us?
Yeah, sorry.
No worries at all. Okay, have you got any insights you'd like to give us? 10 minutes now leading into the number, into the release.
Well, I was thinking that Morgan has already priced in this rate hike, and I'm thinking that the price that the Fed may pay if they stay and hold its way too high on credibility, the Fed won't risk disappointing the market today, but I do believe that the answer it's on, as I do believe Yohay has mentioned for what I heard at the last of his comments, the answer of how the dollar will react today, it's on dot plot and on Yellen statement on the press conference, right? Whether we see upward revisions of inflation, upward revisions of growth, or even more than 2 rate hikes planned for 2017, then that will be generally understood as dollar bullish, right? And on the other hand, if they stay with the ongoing vision, with the current outlooks, that could surprise us and see the dollar falling. And when it comes to that, I was taking a look at the pound today, that ever since we heard of the possibility of a softer Brexit, right? Meaning that the UK will be able to remain within the single market, pound has been rising. So in the case of a weaker dollar, I would go for the pound, right? And I believe that it has more chances to rise than the euro, for example, because I don't see how the euro can sustain any possible gain it may do in the heat or in the motion of the announcement right now. You know, we had today industrial production quite negative, inflation in Germany this week also, right? There's no growth, no inflation. The ECB extended quantitative easing beyond expected last week. So actually, don't trust. For me, don't trust any euro gain today.
Okay. Now, in respect to the dollar, I mean, we've seen a massive shift to dollars. There's a world shortage in dollars. That's one of the things. You know, leading into this event, everyone's been expecting the Fed to hike. I don't think anyone out there, possibly from myself, that could possibly get the Fed hold for a number of reasons. But everyone is priced into the dollar. So on this release and say the Fed hike, could we see actually weakness in the dollar?
Yeah, we could. I believe we could indeed, particularly if the Fed does not offer something else beyond the 25 basis points rate hike.
Yeah, okay. I mean, looking, for instance, looking into, say, dollar yen. We've got dollar yen there, you know, just barely holding on to the 115 handle. I mean, that could be a major mover. I mean, if the Fed were to hold and not do anything, or you know, in the statement not give any indication that they're going to be any more aggressive than we might otherwise expect them to be because of you know, Trump's policies, and we could see a huge shift in dollar yen, don't you think?
Yeah, I agree with that. Indeed. Yeah, go on, Yohay. I'm talking too much.
Valeria had a huge rally since the elections. Were totally different levels than we've had beforehand. You can see here the daily chart. That would be my first pick for reversal. In the extreme case, very unlikely that the Fed does not raise rates, or another big surprise would be not changing the dot plot. Changing the dot plot to hinting about only one hike in 2017. But again, my base case scenario is that the Fed will not rock the boat, only acknowledge higher inflation expectations. That's reality in bond markets, but not go extremely dovish or extremely hawkish.
Right. Yeah, I think Yellen's going to be playing a bit of dodgeball, isn't she, in this press conference?
Yeah. Apart from her first press conference, when she gave a straight answer to a question, she learned to be like any other central banker or politician, playing dodgeball. Yeah.
Okay. Yeah, no, I agree with you. I think my best guess is that there's not going to be a huge amount that she's going to want to put on the table until we understand more what we're going to expect from Trump. And you know, looking again at Trump's policies, I mean, anything that he does start to implement is not going to come to fruition until the second half of 2017 anyway. So, you know, when we're looking at some of those policies, I mean, what are the likely things that we're going to see, do you think? What are the things that he's going to implement first? Do you think it's going to be the corporate tax cuts? Are we going to see any of this fiscal spending happen off the bat? What do we think, guys?
You want my first idea when you asked me that question? It's something we have already commented in here in a previous coverage with Yohay and Mauricio. The fact is, one thing that what politicians promise in campaign, and it's a completely different thing what they actually do when they get to the government, right? I'm not sure if Donald Trump has the correct team In fact, he's still preparing team. He was not ready to win elections politically and economically, I mean, right? So it's trying to decide which policy he will implement first. It's almost like betting, but I guess he will focus on the immigrants issue because that was his first leitmotif, you know? I'm thinking of that rather than any tax cut or infrastructure investment. I don't know. I can't see him acting yet. I would like to be cautious with this one. I would like to see what he does first. Anyway, if I have to go for something, infrastructure is my first idea, but let's see what happens. Still, I do believe it's just an educated guess and far from a reality.
Okay, yeah. 4 minutes until we go. Yeah, so we've got a couple of questions here coming through from the audience. This one is Valerie for you again. Staying here, Valerie, can you suggest gold's next move?
Yeah, well, of course, it will depend on the Fed, but as I've said lately, gold is quite bearish. It's due to safe haven condition. Gold holdings don't don't yield, right? So we run towards gold in the case of risk scenarios, and we sell it when there's something yielding more than gold. So in the case that the Fed hike rates, then that will mean that it will be more profitable, to hold greenbacks than to hold gold, and that's a bearish case for the commodities. Still, remember, guys, we are getting closer and closer to production cost, 1,100 or so. It's the production cost of gold. So, despite I'm seeing it bearish, I do believe that the downward trend is decelerating, and we will probably see some more spikes towards the downside as initial reaction, particularly if we have a hawkish Fed. But I do believe that there is a higher risk that the metal will reverse its course after dust settles, right? In a couple of days, maybe, but it will. So beware of selling too much at this point, or for too long, maybe. But anyway, trying to see what will happen in an event like this one, it's impossible. We need to wait for them to announce and the market to react, and then take trading positions, guys. Don't risk ahead of any of these events.
Yeah, we also need to be data dependent, like the Fed.
Yeah, yeah, sort of. I was watching that the greenback has advanced a bit, some 20-30 pips across the board. And now it's given them back. Market is quite nervous ahead of the event and the announcement. We're 2 minutes away. Remember, guys, we have a bit of delay. Okay, you will see the reaction first in your charts as usual, and heard our comments on it a bit later.
Yeah, seeing a bit of a big
1 minute.
$1.
1 minute, yeah. Go, Yellen, go. Give us something to work with.
Yeah, in too many cases, the Fed has been more dovish than hawkish, and in this case, of course, the dollar will fall and this will also help, of course, gold prices recover to this take profit thing that after the big falls or short covering.
And remember, the market can change its initial reaction as fast as it did with GSDB. With GSDB, we have a 1.87 before we have a 550. So give the market 15 minutes or so to digest news and read beyond the headlines.
It's coming out.
Okay, here we go. Okay, gaps higher towards dollar. I guess we have a hike.
Yeah.
Yeah. We have a hike. Commodity currencies are the ones suffering the most so far.
Yeah. Here's the statement.
Okay, let's go for it.
Yeah, let's see what we have here.
Fed officials see 3 Fed hikes in
Hawkish.
Okay, 3 in the dot plot. Okay.
That's a big move. I must say I'm surprised
No
that they went
dissent.
hawkish. Sorry?
No dissenters. Everyone wants to hike rates. Unanimous vote, 3 rate hikes. At first glance, it looks dollar bullish. So
yes, that is hawkish.
Yeah.
We're seeing a big move there in euro dollar.
Yeah. Euro dollar traders were holding their breath. The pair has traded within what, 70 trades ever since the week started. So there we go. Okay.
PCE inflation predicted up to 1.5 from 1.3.
They plan to do it gradually, and they see the policy supporting some further strengthening.
Okay. Employment, inflation. Do we have upward revisions there? Trying to find out.
So the federal funds rate prediction are all higher for 17, 18, and 2019.
Okay.
Yeah.
So everything looks hawkish. The euro so far has fallen down to 575. So level we can go even lower. I'm noticing that the yen started to bounce around 16, a few pips short of 16. But let's see if the pullbacks, the initial pullbacks we are going to see now, are short-lived or not, and if the pairs can break through those high lows just posted.
Yeah, I put here the dot plot, the sort of central tendency. So here we are. Let's look at this.
Okay, last time the Fed raised rates was last year, right? About this time in December.
December 16th, I checked out the date.
Yeah, so 2 days to complete the year. Okay, gold has reversed all the downward move.
A quick market update then. So Aussie dollar, we've actually seen a low there of 74.69. Yen did actually get through the 116 handle, has come back down. Euro dollar, we've seen a low of 105.74 so far. Cable 126.90. How are we doing on gold, guys?
Let's look at the charts. Well, I think euro dollar bounced its support at 105.75, and gold continues lower. Well, sort of.
Yeah, gold is down and has traded most of its initial loss. The Aussies and the Canadian dollar are the ones suffering the most in terms of pips.
So let's try to read some more from the statement.
Yes.
Look at the dot plot. Yeah, so the big change in the federal funds rate expectation is a rise from 1.1 to 1.4. And also for 2018, it's a small rise from 1.9 to 2.1. And for 2019, who knows, but they have a projection from 2.6 to 2.9. Even the long-term rate moves higher, ticked up from 2.9 to 3. In growth, actually, they downgraded the forecast from 2.1 to 2. The unemployment has been, well, upgraded to dropping to 4.5 in 2017. PC inflation unchanged. Also, core PC inflation, their really, really favorite figure for inflation, has been unchanged.
So do we know yet whether this decision was unanimous? Because I think the dot plot revealed that, you know, those three participants did not expect a hike at all this year. So that will be interesting to see.
Yeah, I guess it's the same three from the previous decision. The Uber doves, maybe. But basically, it's a hawkish decision. I expect the US dollar to rise more. I expected them not to rock the boat. This move from 1.1 to 1.4 in the central tendency for the rate for 2017 is the most significant move. Janet Yellen might smooth that out, might sound a bit more dovish to balance this notion, this initial notion. Let's look at the statement.
Okay, the dollar Japanese yen is at fresh highs, breaking through 16, pressuring level. The euro dollar is also at its low. Sorry, so it seems there's another round of dollar buying right now.
Yeah, I mean, the dollar is strong, but it could be strong. But I mean, like we said, there was so much price into this already.
Yeah. You also see on the CAD are also falling further against the greenback. So there we go.
Party in the USA, yeah.
Yeah.
I mean, we've seen this type of move before on these sort of events, and in fact, you know, you could see people start to cash in on this dollar. You know, obviously we're waiting for the press conference, but you know, we're not seeing a huge rally in this, and you know, I'd be quite nervous actually being in the dollar at the moment.
I think markets are cautious ahead of Yellen's speech because she tends to be soft-spoken, dovish. She might balance it out, but the big event is the dot plot. So I mean, that's what makes the difference.
Yeah.
So far.
I just brought up my monthly chart for euro dollar because we have multiple monthly lows in the 500 region, with the lowest being 460, 2015 low. We are almost there in that region. So, how many of you think that if we lost this area, we will be nearing parity? To be honest, I wasn't able to think about parity, but in this scenario, with the Fed tightening and the ECB easing further, why not?
Yeah, regarding parity, I think it is possible around the inauguration of Donald Trump. More optimism about the US dollar, about the strength of the US economy. And then eventually, well, if parity isn't reached in January, I think we'll have a big reversal afterwards. It won't be reached later on because, as you mentioned before, Valeria, we agree on this, there's a gap between promises of politicians and reality. And within the first 100 days, we could get something from Trump, but markets also tend to get ahead of themselves. So parity, I think, is possible, maybe January. Yeah.
Yeah.
Well, markets are very forward-looking, you know, especially in the bond market and the dollar. I mean, there are so many political risks that we're moving towards in 2017 in Europe. So a lot of that might already be priced in. You know, we had Draghi there, maybe doing enough, you know, on his move, you know, to buffer any kind of adverse volatility, if you like, in the markets. But now I think we could get through parity, you know, relatively soon. As I said, markets like to price things in forward-looking.
Okay, there's a question about Euro GBP, right? Someone's saying, what's the outcome for Euro GBP, right? Can we see price going down to 80 to 90 handle? The fact is that the news is about the greenback, and we're seeing both the euro and the pound falling pretty much evenly, right? So there's not much action going on in the euro GBP, and what probably won't happen. We're talking about 70, 80 pips from current level. I don't see it happening now. The euro GBP moves that large amount of pips when we have an event either in UK or in the euro area, you know, when one of these currencies moves on its own. But ever since this event is about the greenback and both the euro and the pound are moving alongside, I don't expect much action there. Nothing like 80 to 90, at least for today. But tomorrow, I don't know, maybe rise rates and all of a sudden, no, we have a move in euro. Well, who knows? But speaking about this event in particular, no, I don't see any chances of such move. And there's another question. How will the decision affect the price of gold? Well, usually think of the idea that the decision affects gold in the same way it affects the euro, okay? We're talking about the stronger dollar, and therefore gold is falling. I know it may look a bit oversold, but as I said, gold holdings don't yield benefits, and on the other hand, we have the greenback is yielding a lot more than it does yesterday, so it will probably fall. Oversold over both conditions in technical readings, daily basis, intraday basis are not relevant when we have a central bank or payroll or any of these big events in the market. In fact, there we are going. The dollar is riding farther, if I'm not wrong. It's about to, or already did, broke to a fresh multi-month high, right? Gold is falling, Australian dollar also, the Canadian dollar, it's amazingly reacting to the news.
Yeah, I can't explain that.
Me neither.
No, I can.
You can? Okay, go.
If the Fed is optimistic and sees better prospects for the US economy, it means that also the Canadian economy will benefit, because a lot of what's going on in the Canadian economy depends on the US economy and demand from the United States. So that's why it's my explanation. Or it may be just that markets have missed the Canadian dollar so far.
But the Canadian dollar is plummeting. And it's quite wild because oil prices have reached over a year and a half highs. Despite this retracement we are seeing, they're holding pretty well to dollar momentum, right? We are holding about 15 US crude, so okay, there it is, the euro, 560. If we go below 550, oh,
The new high there in the yen, 1647.
Yeah, fresh highs, levels not seen since February.
US dollar is extending its gains. I've examined the first paragraph of the statement, and I noticed that on most things the Fed is sort of mostly unchanged, or I don't know, moderate pace of expansion, things like that. The only thing that they're a bit more excited about is inflation expectations. Quote, market-based measures of inflation compensation have moved up considerably, but are still low. So they do acknowledge that markets expect higher inflation, therefore high rates.
Okay.
It's yet to be seen if these movements are going to be sustainable in time. We still need to hear for Yellen in around, what, 15 minutes?
Yeah, 15 minutes.
Yeah.
Okay, so even dollar momentum ahead of the event, and we need a pullbacks and fresh highs. Seems the market it's really happy buying the greenback right now.
Yeah.
And that will persist into an early Asian session.
Yeah. Speaking of Asia, the Japanese yen, I think, so far is the biggest loser, or
And Canadian dollar is
Canadian dollar as well. Yeah.
yeah, they're both head to head, but yeah, you're right. The Canadian, the dollar, the Japanese yen is among the biggest losers, alongside with the Aussie and the CAD. The pound is about to break 26. That's bad news for the pound. We have a small floor, sort of saying around 25.50, where the pair, the pound and dollar, bottom last week. And enlarge the chart. We have here multiple rows around 25.50. So the fact is that the bullish trend we have seen over the past few weeks is not actually at risk unless we break below that area. That will discourage bulls indeed, and we can see the pound plummeting for further.
So these moves.
Yeah, go. Sorry.
Okay. So these moves that we're seeing today, basically paving a way for the basis of 2017 for a strong dollar environment. Are we all agreed on that?
Early in 2017, yeah. And then I think things could reverse depending on Trump, depending on the Donald, yeah.
Okay. So, I mean, do we have a target for dollar yen to the psychological 120? And by when?
I have a first target around 1660. So I'm not that ambitious. As I always said, I can't see that far away without my glasses. But indeed, yeah, there's of course room for further gains up to 120. Still, I can see them. Keep in mind that by the end of the year, and in fact, in January, February, the yen tends to appreciate, and that we have been up for 5 or 6 weeks already in a row. So at some point, the pair will exhaust. But my main target right now, it's 118, 1850. We have multiple weekly highs and lows around that area. And that's the most I can see the pair rising right now.
Yeah, that'll be the 15th of October lows, right?
Yeah.
Yeah, we will need to see some kind of a correction, I guess, for the pair to move higher. Of course, the cycle high was 125. That's a bit far off. 118, 120 are lines I'm looking at. But looking at this daily chart, we've seen much tighter range trading and then this huge move to the upside. So sure, the yen, when it picks a trend, dollar yen moves non-stop. Yeah, I learned that from you, Valeria.
Yeah.
But still, I would expect some kind of a correction at this point.
I mean, the key here is, I mean, we've had the DXY break, very critical resistance. It's been in that sort of sideways channel for some time, and same with euro dollar on the downside. Now you've got the divergence here extending between the BOJ and who are just ready to print the yen into oblivion. So you've got all of the fundamentals and you've got the technical levels backing this up. I just wonder if the market is just a little bit too eager in the dollar at the moment, and like you said there, there could be a correction. So that's something to be considering. And if there were a correction and looking at dollar yen, where would that lead us to, do you think? We're back down to sort of 114.80 and some sideways action from there, or do you see further slippage lower?
I have to, at least me, I have two big lines in the sand in the dollar position towards the downside. The first will be 114. Because it stands for the 23.6% retracement of the rally between 2011 and 2015, the Abenomics rally. Okay, so that's the first level to watch. And below that, 1280. I believe that we can correct down to that level without actually harming the bullish trend. Indeed, it will be a bit too much, but considering how much the pair has rose these days, it will be understood as a correction.
Yeah, my levels are similar. 114.80, the recent lows. 114, which was a high in late November. Yeah, 112.80 that you mentioned, and below that, sort of a much bigger line. A huge correction would be up to 111.40, but I don't expect that, especially in light of today's relatively hawkish Fed decision.
Yeah, me neither. I'm not saying that I'm expecting those levels, just in case, to make it clear.
Yeah, with 9 minutes now until the press conference.
Okay.
So what are the key things, guys, that we're looking for in this press conference? I think we're all agreeing that, like I said earlier, Yellen's going to be playing a bit of dodgeball, I think. She's not going to want to put too much on the table. We're looking for a less hawkish tone than what we're seeing in this dot plot to sort of balance things out.
Yohay? You want to answer?
She'll try to be as balanced as possible, dodging political questions. Of course, there will be questions regarding Donald Trump and what he said about her term. She'll dodge all the questions. The bigger issue, for markets, they'll try to pin her on these 3 rate hikes for 2017. Is it real? Is it serious? And she'll say it's not a commitment. As usual, we're data dependent. We move gradually. Monetary policy is still accommodative. I think she'll try to smooth out the impression that the change in the dot plot has given. If she will be more upbeat on the U.S. economy, then the U.S. dollar could extend its gains. At the moment, what I see on the charts is we had a hawkish move, and we are now waiting for Yellen to either confirm or to smooth or reverse these kind of moves. Yeah.
Okay, so the effect would be then a short dollar. See a pullback if she's more balanced and not as hawkish as what we're seeing in the dot plot. We'll see some profit taking. Do you think?
That's my tendency. Sorry, Valeria, go ahead.
Not sure that the market will take profits out of this movement after Yellen, but well, we will see.
7 minutes to go.
It's just hard to see a hawkish Fed. I'm used to seeing them so dovish, so it's a bit surprising that they raise expectations.
I don't know if the market has high expectations about what Yellen said, because she got us used to said nothing, right? So the attention was, or the focus was the dot plot, and the market got what it wanted to buy the greenback from there.
Yeah.
We have a couple of questions. One says if gold is oversold. At this point, everything is oversold over both. But as I said earlier, technical readings have nothing to do with this. When you have a big event such as a central bank or non-farm payrolls or something like that, market pass beyond technical readings, right? So it will depend on Yellen now. If Yellen is hawkish, we will probably see the dollar keep on rallying despite any oversold over both condition. Okay, and there's another question about the Chinese yuan. I guess I have never saw it. I don't trade it, so sorry, I can't help you with that.
Yeah, I can offer some general commentary about the yuan. The yuan did weaken against the US dollar, but after the elections with the strengthening of the US dollar, but the Chinese authorities are actually trying to keep it from falling too much. That's bad for outflows of capital and things like that. And despite the weakening of the yuan against the dollar, it's still strengthened against quite a few other currencies, especially their big rivals in Japan. the third largest economy of US, the second largest. So I think, well, if the dollar will continue strengthening, 7 on dollar yuan is possible. I think the Chinese authorities will try to avoid this round number, especially with Donald Trump talking about labeling China as a currency manipulator.
Yeah, there's going to be a lot of pressure on China in that respect, as you said. With Japan there and Korea, it's very risky for those nations as well, because they're major exports, as is China exporters. So I'd agree with you there. Okay, guys, 4 minutes until the press.
Yeah.
Yeah.
So looking at yields, the 10-year yield has actually come back down to 2.5%. So that's slightly down.
I was not watching yields. Give me a second.
Yeah, looking at euro dollar, we're also seeing, a bounce from the lows, some caution. Maybe markets went too far with the reaction to the hawkish move. So we're some 20 pips above the lows.
Yeah, nothing. How about stocks? Little reaction so far.
Yeah,
Though it's
pretty choppy. Not much reaction.
Yeah.
This is really an expected move, so that's quite things.
Okay, yeah. Some 20 pips, 20 points, lower, but nothing. Actually,
they're just, they're incredible. They just keep going. The Dow has been 7 consecutive days, getting up to that psychological level today. S&P trading slightly below it, and the Nasdaq, but it's quite impressive, isn't it? And the complete opposite to what everyone had positioned themselves for on a Trump victory.
Yeah.
Yeah, it was amazing.
We're calling for, big sell-offs and so much uncertainty, etc. And within moments, straight back the other way. And again, this is back to the idea of the presidency and the fiscal spending and all the benefits for corporations and the corporation tax. But we just wonder when that can actually be implemented. All these things take a long time to go through. There's a process to it. And, I'm just wondering if the markets are getting a little bit ahead of themselves.
Regarding Trump, yeah.
Yeah.
He made huge promises. He used big words, bigly words, and markets got ahead of themselves. Remember that Republicans, at least in theory, are the party that support small government, smaller deficits. So I would expect some kind of fiscal stimulus, but definitely not an extreme version. Definitely not one that will cause significant inflation.
Yeah, because there's that argument that we're now entering a period of reflation against a backdrop of stagflation that we've been in. But the thing is, that throughout history, we've not had many episodes of stagflation to really to be able to use it as a benchmark, for what the outcomes may be. So this is unprecedented times, isn't it? Really. Yet the markets are looking for yield and they're bullish. 30 seconds, guys.
Market is on full dollar nominated demand assets after Trump promises, but it's, as I said, a weighted distance. Anyway, we can go against this market enthusiasm right now, so I'm expecting more gains, both in stocks and in currencies, in the greenback against currencies.
Until the market looks at the risks of higher rates, will they offset the benefits of corporate taxation, for instance? Here we go.
Okay, starting.
Yellen is taking a seat now. So I believe we're going to show the press there, aren't we?
Yeah. Just not like Draghi. You can't tell if we are going to have good news or bad news with Draghi, or just looking at his face, but he came into the room. And Draghi.
All right, Yellen. I can't hear.
I can't hear either. I just can see.
Are we having some technical issues in showing it?
Objectives of maximum employment and price stability. Over the past year, 2.25 million net new jobs have been created, unemployment has fallen further, and inflation has moved closer to our longer run goal of 2%. We expect the economy will continue to perform well, with the job market strengthening further and inflation rising to 2% over the next couple of years. I'll have more to say about monetary policy shortly, but first I'll review recent economic developments and the outlook. Economic growth has picked up since the middle of the year. Household spending continues to rise at a moderate pace, supported by income gains and by relatively high levels of consumer sentiment and wealth. Business investment, however, remains soft, despite some stabilization in the energy sector. Overall, we expect the economy will expand at a moderate pace over the next few years. Job gains averaged nearly 180,000 per month over the past 3 months, maintaining the solid pace that we've seen since the beginning of the year. Over the past 7 years, since the depths of the Great Recession, more than 15 million jobs have been added to the U.S. economy. The unemployment rate fell to 4.6% in November, the lowest level since 2007, prior to the recession. Broader measures of labor market slack have also moved lower, and participation in the labor force has been little changed on net for about 2 years now, a further sign of improved conditions in the labor market given the underlying downward trend in participation stemming largely from the aging of the U.S. population.
It's quite optimistic.
Looking ahead, we expect that job conditions will strengthen somewhat further. Turning to inflation, the 12-month change in the price index for personal consumption expenditures was nearly 1.5% in October. Still short of our 2% objective, but up more than a percentage point from a year earlier. Core inflation, which excludes energy and food prices that tend to be more volatile than other prices, has risen to 1.75%. As the transitory influences of earlier declines in energy prices and prices of imports continue to fade, and as the job market strengthens further, we expect overall inflation to rise to 2% over the next couple of years. Our inflation outlook rests importantly on our judgment that longer-run inflation expectations remain reasonably well anchored. Market-based measures of inflation compensation have moved up considerably, but are still low. Survey-based measures of longer-run inflation expectations are, on balance, little changed. Of course, we remain committed to our 2% inflation objective and will continue to carefully monitor actual and expected progress toward this goal. Let me now turn to the economic projections that were submitted for this meeting by committee participants. As always, they conditioned their projections on their own individual views of appropriate monetary policy, which in turn depend on each participant's assessment of the multitude of factors that shape the outlook. The median projection for growth of inflation-adjusted gross domestic product rises from 1.9% this year to 2.1% in 2017 and stays close to 2% in 2018 and 2019, slightly above its estimated longer run rate. The median projection for the unemployment rate stands at 4.7% in the fourth quarter of this year. Over the next 3 years, the median unemployment rate runs at 4.5%, modestly below the median estimate of its longer run normal rate. Finally, the median inflation projection is 1.5% this year and rises to 1.9% next year and 2% in 2018 and 2019. Overall, these economic projections are very similar to those made in September. GDP growth is a touch stronger, the unemployment rate is a shade lower, and inflation beyond this year is unchanged. Returning to monetary policy, the committee judged that a modest increase in the federal funds rate is appropriate in light of the solid progress we have seen toward our goals of maximum employment and 2% inflation. We continue to expect that the evolution of the economy will warrant only gradual increases in the federal funds rate over time to achieve and maintain our objectives. That's based on our view that the neutral nominal federal funds rate, that is, the interest rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel, is currently quite low by historical standards. With the federal funds rate only modestly below the neutral rate, we continue to expect that gradual increases in the federal funds rate will likely be sufficient to get to a neutral policy stance over the next few years. This view is consistent with participants' projections of appropriate monetary policy. The median projection for the federal funds rate rises to 1.4% at the end of next year, 2.1% at the end of 2018, and 2.9% by the end of 2019. Compared with the projections made in September, the median path for the federal funds rate has been revised up just 0.25 percentage point. Only a few participants altered their estimate of the longer run normal federal funds rate, although the median edged up to 3%. Of course, the economic outlook is highly uncertain, and participants will adjust their assessments of the appropriate path for the federal funds rate in response to changes to the economic outlook and associated risks. As many observers have noted, changes in fiscal policy or other economic policies could potentially affect the economic outlook. Of course, it is far too early to know how these policies will unfold. Moreover, changes in fiscal policy are only one of the many factors that can influence the outlook and the appropriate course of monetary policy. In making our policy decisions, we will continue, as always, to assess economic conditions relative to our objectives of maximum employment and 2% inflation. As I've noted on previous occasions, policy is not on a preset course. Finally, we will continue to reinvest proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. As our statement says, we anticipate continuing this policy until normalization of the level of the federal funds rate is well underway. Thank you. I'd be happy to take your questions.
Just 0.25% higher.
Secretary with the Wall Street Journal. Why does the Fed now see 3 rate increases next year instead of 2? Is it because the economy is at risk of overheating, or is the Fed behind the curve, or is this a reaction to Donald Trump's election?
Well, I would like to emphasize that this is a very modest adjustment in the path of the federal funds and involves changes by only some of the participants. So in thinking about the paths and the revisions, there are a number of factors that were taken into account by participants. The unemployment rate is perhaps a touch as I said, a touch lower than previously. You've seen some modest downward revisions in that projection. For this year, there was a slight upward revision to inflation. And some of the participants, but not all of the participants, did incorporate some assumption of a change in fiscal policy into their projections. And that may have been a factor that was one of several that occasioned these shifts. But I want to emphasize that the shifts that you see here are really very tiny.
Steve Leisman, CNBC. In recent testimony, you said your advice was for fiscal authorities to increase the productive capacity of the economy. Do individual and business tax cuts increase the productive capacity of the economy? And how would the Fed's reaction be different to fiscal policies that increase the productive capacity of the economy and those that don't?
So the statement that I made that it would be useful to increase the productive capacity of the economy reflects my concern that productivity growth has been very low. It's the ultimate determination of the evolution of living standards. Policies that would improve productivity growth would include policy changes that enhance education, training, workforce development, policies that spur either private or public investment to enhance the quality of capital in the United States that workers have to work with, and policies that spur innovation or competition or the formation of new firms. So tax policies can have that effect. It really depends on the specifics. I don't think there's anything that I could say in general about what tax policy would do, but and I really can't tell you what the Fed's response would be to any policy changes that are put into effect. I wouldn't want to speculate until I were more certain of the details and how they would affect the likely course of the economy.
But if there was a rush of fiscal policy that did not increase the productive capacity of the economy, would that mean the Federal Reserve would have to move more quickly with raising rates?
It's something I really just can't generalize about because while it would be desirable to have tax policies that do increase the productive capacity of the economy, an increase in the pace of productivity change is one of the factors that does affect the economy's neutral rate. A boost to productivity could spur investment. As we've been saying, we estimate that the value of the neutral federal funds rate is quite low, and one of the reasons for that is slow productivity growth. And so it's very hard to generalize about it because it could affect that neutral rate.
For the average American, can you explain what the impact of this hike and 3 additional hikes will be next year? And should they feel more confident in the economy now that you are raising rates at a slightly faster pace?
So let me say that our decision to raise rates should certainly be understood as a reflection of the confidence we have in the progress the economy has made and our judgment that that progress will continue, and the economy is proven to be remarkably resilient. So it is a vote of confidence in the economy. As you know, this was a decision that was well anticipated in markets, and I think it will have relatively small effect on market rates. It could boost very slightly some short-term interest rates that could have an effect on borrowing. costs that are linked to them. But overall, I think that households and firms will see very modest changes from this decision. But certainly it's important for households and businesses to understand that my colleagues and I have judged the course of the U.S. economy to be strong, that we're making progress toward our inflation and unemployment goals. We have a strong labor market, and we have a resilient economy.
Used confidence also last year.
Clearly, there's been a lot of discussion already about fiscal policy, but even if you discount don't know what the fiscal outlook is going to be next year, unemployment is already below the longer run projection. Under the policy rule you cited in your August speech, that would suggest that policy ought to be tighter. Is there a risk that the Federal Reserve is already behind the curve even before any fiscal impact steps in next year? Thanks.
So I would agree that, and as we said in our statement, policy remains accommodative. The degree of accommodation I would characterize as moderate. As I've emphasized and said in the statement, we currently judge the neutral level of the federal funds rate to be pretty low. So there is some accommodation. Remember that inflation is still below our objective. The committee projects, at least the median projection shows, a very modest undershoot of estimates of the longer run normal rate of unemployment. The median unemployment rate here gets down to 4.5%, which is just a few tenths below the estimated longer run normal level of the unemployment rate. And we think that that's appropriate because we want inflation to rise to our 2% objective in a timely fashion. So there is not a substantial undershoot of the natural rate of unemployment. We're not seeing evidence in labor markets of very substantial upward pressures on labor that could signify extreme shortages of labor that could propel inflation higher in a very rapid way, and inflation is still operating below our objective. So I do not judge that we are behind the curve. My judgment is that we're in a good path to reaching our objectives, but of course the outlook is uncertain. We recognize that there are many sources of uncertainty affecting the outlook, and we will have to adjust our thinking as things evolve, as conditions evolve, and we learn more about economic policy changes that could affect the outlook.
Data dependent.
Yeah.
Okay, guys, so just summing up. So the Fed has hiked by 25 basis points. They've crucially signaled 3 more hikes in 2017 up from 2 previously. And then some of the key other takeaways there, I mean, despite this, you know, the other forecast variables are a little changed. Probably the most noteworthy one to look at there would have been the GDP. It's now expected to be 2.1%, but no further increases are expected in 2018. So this is unchanged at 2%. The 2019 GDP forecast is also only slightly higher at 1.9%. But again, the big takeaway from this meeting was the increase in the pace of tightening signaled for 2017. So really summing up, I mean, this is a peculiarly hawkish set of forecasts against not a particularly hawkish statement. There was nothing really there in the presser to go on there, and the dollar's given some back. There was one exception of the market-based inflation expectations, but there is no change to the investment policy. So, I mean, my takeaway from this, though, really is that, you know, it's worth bearing in mind that the Fed, you know, has forecast significant tightening before, only for events to overtake them. And that's something that Yellen was there alluding to in that final question. So, there's a lot of things that can still go wrong, including the European political calendar and the delivery of stimulus taking longer and delivering less than the market is currently expecting. So guys, what are your takeaways from this, and what are your forecasts from Burland? Starting with yourself, Yohay, if I may.
Well, he's laid out most of the things. I would add that Janet Yellen did downplay the importance of the dot plot. She mentioned that it's just 1/4 of a basis point higher. Of course, for markets, it is a big deal, but she said the word just several times. And she said it's only a few members that changed their mind. And as you mentioned, last year they projected 4 hikes and they implemented only 1 today. So I think the dollar's gains, I mean, she did talk about confidence, growth, well, they acknowledge higher inflation expectations. They are positive. The Fed is in divergence, I mean, different than other central banks like the ECB, the Bank of Japan, especially regarding monetary policy, but they are not going ahead of themselves, are totally uncertain about fiscal policy as expected. And again, slightly less optimistic, taking the dot plot a bit less seriously than perhaps markets are. So from here, I would expect, looking at the charts, maybe in the Asian session, maybe tomorrow morning, a bit more of dollar gains, but I'll expect sort of a repeat of what we're seeing today, sort of limited gains, not over the top. It's a bit less hawkish than we heard half an hour ago.
I will add to Yohay comments, and I will use the new favorite word from Yellen's new favorite word, just. The statement was, or the Fed decision overall was just hawkish enough to trigger this dollar rally, to give the market what the market wanted, and no more. You know what I mean? I guess the main concern of Yellen before making, not only Yellen, but all policymakers before taking this decision, was preventing stocks from plummeting, and they do achieve that today, being just hawkish enough.
Excellent. Okay, and then this leads me to this Friday, the 16th of December. We'd like to invite the audience that are listening today and many others. We've got 2 panels for 2017. We have the traders panel, and we're inviting guests from the industry. We've got a very strong panel there that are going to give some technical forecasts for the foreign exchange market. And that will come after a fundamental panel that we'll be holding, where we've invited actually Harry Dent, who's a financial author and founder of Dent Research. He'll be joining us live from Florida, and with yourself, Yohay, we'll have you back live from Barcelona. So they're going to be some very, very insightful panels and something to put down in your diary and try and attend if you can make it, and that's speaking to the audience. So thank you very much, everyone, today. That was eventful. It was kind of expected, the sort of moves that we've been talking about. I think they played out, and we got a pullback there in the dollar and upwards and upwards. So thank you very much for listening to our audience, and we welcome you back to any others that we'll be showing in the future very shortly. Thank you very much.
Okay, thank you very much. A pleasure to be with you guys. See you.
Yeah, pleasure.
Bye-bye.
Ciao.